welcome to the May edition of the Ag Economic Dialogue session, everyone. We're glad you were able to join us. And just a reminder that we'll do this again in June. So if you haven't registered for the June session, please do that on our on the webpage. So we do have a guest presenter with us today, Dr. George Langelett from the Ness School of Management and Economics. And I probably didn't say all that in the right order at SDSU, but he's going to share a little bit of different information with us today. And then we will follow that up with Jack Davis with some other more local information is the way I understand the way things are going to go today. So with that, George, I'll just let you introduce yourself. You can share your screens, unmute, and away we'll go.
Yeah, good morning, everybody. I am George Langelett, and I'm I would say a generalist economist, and I teach both macro and microeconomics, and I think there's some crossover between what I'm going to talk about today in terms of currencies and the impact on agriculture. I'm going to see if I can go ahead and share a screen here. Everybody see this?
Yes, that will work. If you go to slideshow mode, we'll be perfect.
Okay. Yeah, so I am George Langelett. Today I'm going to talk about currency regimes, and topic that not too many people are following closely. It's something I have been following, and we'll see the impacts. Look at the impact today on demand for U.S. commodities. So since really 1450, we've had 6 major reserve currencies around the world. 1450 to 1530, Portugal, at that point, pretty amazing, was the dominant power in the world. And with the dominance of their regime, they also had the reserve currency for the world. Spain, 1530 to 1640. And then the Netherlands from 1640 to 1720. And with that, if you remember, we have the famous tulip bubble. We talk about bubbles in different commodities or assets, whether it's stock market or housing. But actually, it's interesting. The first one I'm aware of really was an agricultural bubble, the tulip hysteria that went on for a while before that popped. France, 1720 to 1815. And surprisingly, even with the French Revolution, with Napoleon changing things, they understood the power of the economy, and it survived the French Revolution. Great Britain then took over in 1815, all the way up to 1920, and unfortunately, paying for World War I really bankrupted Great Britain, and at that point, 1921, the United States became the reserve currency of the world. And talk about this a little bit more, but as reserve currency of the world, basically all prices of all assets and goods and commodities around the world are priced in dollars. And kind of, I don't know if it's fate or just kind of a anomaly in the trend, but most currency regimes last about 90 years on average. So really going back to World War II, the entire Europe, Japan was leveled. We were really the last country standing. And out of World War II, when Einstein got a hold of Roosevelt, said there's something Hitler's working on, and I encouraged the United States to work on it, the atomic bomb, down with the Manhattan Project. When we actually exploded it, we realized, no, we can't do this. World War I ended, and we kind of blamed Germany for all the problems. We cannot do this. So when World War II ended, we said we have to do this differently. When World War II ends, we got to welcome Japan and Germany as part of our community, welcome them back into the community. So even before World War II ended, in a little town, Bretton Woods, New Hampshire, the world leaders, Roosevelt and Churchill, got together to say, how are we going to have a post-World War II world? And with this, really, three major institutions. The United Nations was established really to create some dialogue between countries. So hopefully, instead of going to war, we can negotiate between countries. And the World Bank was established to help with the reconstruction of Europe. Most of the countries in Europe were just leveled, so they didn't need construction loans. And the IMF was established to work with countries throughout the world to provide really development loans to countries around the world and really help them with their economic growth. And throughout all of this, we decide really what we're going to do is have the US dollar, we're going to peg it to gold. Much of the gold after World War I from London had gone to the United States to pay for the weapons in World War I. So we're going to peg the US dollar to gold, and then every country on earth will peg their currency to the US dollar. So at that point, the United States became the reserve currency of the world. So after World War II, we were really the last country standing, and we talk about our dominance. Well, basically the industrial base of London, Germany, Japan, the industrial base of the world had temporarily been wiped out. It would take a decade to rebuild. So after World War II, we were actually over 50% of the world's GDP. And over time, as countries have developed and grown, our dominance in terms of GDP of the world has eroded. 2020, we only account for about 23% of the world's GDP. And we kind of sometimes success creates difficulties because we actually overestimate ourselves. And it's not just LBJ, there was a number of overspending throughout the years, but kind of the classic case in 1960s, LBJ, President Johnson, tried to do both guns and butter, created the Great Society. We're going to stomp out poverty once and for all in the United States, and then also to stop the communists. We fought the Vietnam War. And we were overspending, and with that, we realized we were running out of gold to back up US currency. So in 1971, with the realization, and we realized that they did not want to admit it, Nixon ended the gold standard. So now, after 1971, we have what's called fiat money or by decree money. So our currency really has value because we accept it, people around the world accept it, and also because it's legal tender. In the United States, you have to accept the US dollar or the Federal Reserve note for all debts, public and private. And then also really, we said it was a regime change at that point. We switched from gold back to what we call the petrodollar. And we have an agreement with Saudi Arabia that we would protect their oil. They would not have to worry about protection. The US military would protect Saudi oil. And in exchange, oil around the world would be priced in US dollars. So we had a regime change in 71, went on the petrodollar standard. So today, the United States is the reserve currency around the world. All currency today is priced in US, or actually all trade is priced in US dollars. So let's say Mexico wants to trade with Brazil, and they will trade, but the goods are priced in US dollars. And equally important, contracts around the world. If you look at contracts, futures contracts, and also countries looking to get a loan from the IMF, development loan, it's priced in US dollars and it's to be paid back to the IMF in US dollars. And I talk to my students, and Walmart, go to Walmart and there are products, most of them coming from China. Actually, the components are produced in every country around the world. Really, they're shipped to China, and China is really the center of assembly. So they assemble the products and they ship it to us, and we put it for sale in Walmart. But I asked the students, what are we giving them in return? Because everybody wants to be paid. But we're realizing for a large portion of this, we are actually sending them dollars. And developing countries need those dollars to repay their loans. They need to buy commodities. Everything is priced in dollars. So to buy goods around the world, they need dollars. So really, some of the countries now are beginning to resent it a little bit. We're getting goods basically from all over the world. We're printing dollars and shipping them out. So we're with the printing press, we're able to buy goods and services. So we're really exchanging pieces of paper for goods. And it's kind of caused some resentment around the world and more frustration with the United States. Back when we were on the gold standard, it's kind of acceptable because countries around the world realize that there is a commodity backing this up. So there's kind of created some grumblings over this past 2 decades of the United States has an unfair advantage over other countries because of the reserve status of the US dollar. So this war in Ukraine has, when I first heard the war, I meant, well, yeah, Ukraine's just another country, but it's really been a hot spot in the world. And it's, unfortunately, I don't see either the United States or Russia backing down from this war anytime soon. But with the war in Russia, the United States and European countries decided to boycott Russia. So Russia reached out to potential allies. They reached out to China, Brazil, South Africa for support, and India. And these are really known as the BRICS nations. And with that, they're asking for support, and these countries have decided to really support Russia in their war effort, but also really to step back and step away from the US dollar. And if you think about it, Russia and China really are natural trading partners. Russia has the raw resources, it has the energy. China has virtually no energy, but China has the manufacturing. So Russia sends energy to China, China sends finished goods to Russia. They became natural trading partners. So over this past year, Brazil, Russia, India, and China, and South Africa, called the BRICS nations, have agreed on a new currency bloc. And the difference is the United States and the Western European central banks are all fiat or paper currency. And the BRICS nations, their currencies will all be backed up by commodities. Russia and China will be backed up by gold. Saudi Arabia is talking about joining. They'll be backing up their currency by oil. And each country will be required to back up their currency with a physical, tangible asset that has value. The value of the asset will give the currency its value. And so the agreement is, once the currency is acceptable to BRICS nations because it's backed up by commodity, payments will be made in any of the BRICS currencies. So if you want to trade in yuan, if you want to trade in the ruble, if you want to trade in the Indian rupee, yes, you can trade in those currencies. Or if you want to price things in yuan or price them in the ruble, we can use any of these currencies for both for trade and for really the, what's the word, the standard of value or the pricing can be priced now in not only US dollars, but in the BRICS currencies. And the most recent thing I've read is, to date, 87 countries around the world have now applied to join the BRICS countries. Many countries in Africa, the Middle East, South America are now applying. I believe England is also applying. They will be using the silver sterling to back up the pound. And so in next month, June 2023, they are going to have a conference, and they're going to review the application of each of the 87 countries and see which countries will be allowed and will participate in this new currency regime. One caveat, and we'll see actually if they're serious or not. Sometimes I'm not sure if it's legit or if it's just headlines, but Texas, the state of Texas, has always been a little bit independent, and they're really dissatisfied right now with the US dollar. and they've applied. They'd like to create their own currency, which will be backed up by gold, and they'd also like to join the BRICS nation. And I don't know how much this will be, I don't know how much of this is legal in the United States, but we'll see how this plays out. So right now, yes, 87 countries are applying to join the BRICS currency bloc. Now, we also have what's called the SWIFT payment system. And this is how payments are made between countries. Right now, the US Federal Reserve and European central banks use the SWIFT system for settlement of payments. So for example, if the US sends a shipment of soybeans to China, how do we get paid? It is paid through the SWIFT system. So part of this conference in June, the BRICS nations want to set up their own settlement system for payments between countries. And as some of you may have noted, Saudi Arabia last month in April, they switched now from pricing oil in US dollars. They're now pricing oil in Chinese yuan. And this is kind of a shift in attitudes around the world and a little bit of a move away from the US dollar. And kind of one other side note, this is a different topic, but it's related. To deal with COVID, the FDIC and the Federal Reserve in 2020 brought the reserve requirement for banks down to 0. Now, your reserve ratio is the amount of your deposits that must be set aside to help customers coming into the bank. So historically, it was about 8 to 10%. I personally like a 10% reserve ratio. So if you put $100 into your bank account, the bank is required to, at a 10% reserve ratio, the bank is required to keep either $10 at the bank or at the Federal Reserve, just in case you write a check or come in and need some currency. And with the COVID crisis, they decided to help with liquidity to drop the reserve ratio for banks down to 0. Now, the last few weeks, we've had several banks really go bankrupt. It's kind of difficult to see, but the most notable, Silicon Valley Bank. We also had First Republic and a couple of other banks go bankrupt. And it'll be interesting in a few years as we study this. I don't know how much this idea of going to a 0 requirements for reserves, they could basically all the deposits lend out or put into assets. I don't know how much that played into it or not, but it'll be interesting to see over time. But we also have internationally, it's called Basel IV, and this is from the international banking community, and they reached the agreement of Basel IV. So it will require banks around the world to have a 20% reserve requirement if you're going to be part of the SWIFT system. So US banks will have 5 years to get to compliance, but as banks are lending less out and keeping more as reserves, that potentially has an impact if not the base, the monetary base released by the Fed, but the total money supply through the expansion of fractional reserve banking system. As the reserve requirements go up, the global reserve banking system will actually be contracting the money supply. So we may see a contraction in the money supply over the next 5 years as banks are required, want to participate in international. If you're a bank and you don't want to participate in international transactions, you don't have to have this requirement, but any bank that's part of the SWIFT system for international settlements has to be Basel IV compliant over the next 5 years. So as the United States loses dominance due to the rise of the BRICS nations, most economists are saying this is going to be a slow process. Setting up new currency regimes, new settlement systems takes time. So most economists expect kind of a devaluation of the dollar. And we're kind of going, the idea is we're going from a single polarity in the world, just US dollar, to a multipolar world. And we expect the US dollar to still be the dominant currency in this multipolar.
Come on, get over here.
But
Come on.
we have
Stay by me. Come on.
so most people expect this to be over the next 5 to 10 years, kind of a gradual decline in the US dollars. We move from a single polarity to a multipolar world in terms of currencies around the world. One caveat, and it would be, in my opinion, silly if, there's a lot of rhetoric between the US and China about going to war. I don't think it will happen. I think it'd be very silly on both sides if we would go to war. But China has threatened if the United States and China would ever go to war. China holds about 1 trillion in US debt, government savings bonds. Saudi Arabia has about 500 billion, 500 billion in US debt. And both countries have kind of threatened to basically sell them all off or dump them in the case of a war. Kind of, it's not only a military threat, but an economic threat. So if this would happen, it might be a rapid decrease in the value of dollar. But most economists do not expect this. We expect to be a gradual decline as the United States loses its dominance as the world's reserve currency. And so as an economist, I would say as the US dollar falls, I'm going to expect, and as the price of US goods falls, I'm expecting demand for agricultural commodity products to rise over the next decade. So this is most of my presentation. I'm going to open it up for any questions you may have.
Thanks, George. That was very interesting information. Questions from anyone? Feel free to ask them now if you want to unmute. Otherwise, we will roll into Jack's presentation and then do a question and answer session at the end. I don't see anybody unmuting their microphones, so let's roll into Jack and we'll do questions at the end. Thanks, George.
Okay, that should be showing up and sounds okay.
Everything looks good.
All right. So we're going to look at WASDE, and that, of course, has our first look at new crop. When we scheduled this, we thought maybe there would have been some issues planting. That really is not a story. Well, I guess the story is that it's been really fast, and that's the story, except for North Dakota, and they're behind a little, but they're going to surely catch up quite a bit this week. And it's not a large production amount compared to nationwide. So I think a lot of the things that George talked about are having an effect on some of the prices that we're seeing. And we'll take a look at what WASDE or we're looking at for our first look at the new crop of 23. There's just the contact information, and I'll have that again at the end. We'll take a look at the balance sheet here, and then I'll have these in the graph so we can look at them graphically over the last 20 some years, and that helps give the big picture. I think last year, as we came out of 22, one of the big things was the amount of acres, drop down to here, that got harvested. Our yield was pretty consistent with, it was probably below trend, but consistent with the last few years. But we really dropped in the number or percentage of acres harvested for corn, and which really would have just been some went to silage, some abandoned, and a lot of that's really dry. And Nebraska was huge for the amount that they ended up cutting for silage, and they're a big producer. And they still have been pretty dry coming into this year, but we'll see as that plays out. So here's again the crop we're using up. I think the big story there is probably exports, and we know that would have been the negative news. I think that was today or yesterday. And we all knew it, the cancellation that took place, but also there was some cancellations from Mexico. So just exports continue to drop off and not meeting what USDA had originally projected for 22. So we'll see how that continues to play out. So in turn, what happens then, our ending stocks continue to rise, which gives our beginning stocks higher going forward into our new crop that is going to be harvested. And always that first look at the new crop is really going off of historical numbers. So make an estimate of what is planted, based on intentions report and weather, and always expecting harvest to come in about at 8 million acres less than what's planted. So right in there, and then using the trend line yield, which we haven't hit recently. And when you add all that together, it leads to a lot of production. And with demand kind of slowing, we could increase our ending stocks above the 2 billion bushel level, and the stocks to use ending at 15 versus where we're estimating now at 10, and in recent years down around 8. So that's we see the drop off in price. Now we'll just look at these line items through a graph. So as you can see, just our production going forward. Quite a rise from last year, and we'll see in another slide as we go on that it is a lot of that was abandoned acres versus necessarily yield. Feed and residual really staying pretty steady. I think last year as corn gets to that point that we find some substitutes to feed, and we don't feed quite as much. So as we're looking at corn getting cheaper, hopefully it brings back that demand to use the corn up. This is the food, seed, industrial. So our biggest thing in this is ethanol. On that, really staying steady. We kind of dipped a little bit in 21 to kind of anticipate that to rebound and be similar. Not quite as high as we were back in here, but still not dropping off too terribly much yet. And there is our ethanol, similar to 21s. And here we see the exports. I think it just reiterates it graphically how we dropped off in this year's the crop that we're currently using up, and how that has dropped from previous years when our corn is more competitive in the market. Going forward into the new crop, anticipating that somewhat to rebound, and again, time will just tell on that. So here's our current ending stocks estimate. And as I said, the exports falling off, that may rise yet more if our exports continue to fall and can't keep pace. We are 80% on the new crop. We're 80% below sales where we were previously. So that will be interesting as we go forward on the export side. Just to look at acres and yield, kind of been in that mid 170s for most of the part last few years. And again, anticipating a 181, which would be our perfect growing year. And here we see that drop off in harvested acres with it popping back up for anticipated in 23. Again, time will tell as we go forward. This is put together by Dr. Dearson. He's off in New Zealand now, guiding some students around. And so not updated this time, but I thought I would share it as he would project stocks to use in that mid 15 around 460 to 480 price. And that's really kind of right where we are falling currently, looking at our new crop. Just wanted to show high 1/3 pricing range. This is on a futures level for new crop is what it picked, a long-term new crop chart. And I just split it into thirds, taking this high and this low, and then dividing them off into thirds. So we're approaching that lower mid to the bottom third on our new crop pricing currently. Kind of rebounded today. It's important that it stays above that $5 level on the futures. So we'll see how this, if we put our low in this week for the summer and start to focus maybe more on some of the drought yet and growing conditions versus just the speedy planting. Got a few charts here I wanted to share just in comparison. And what I've done is take a new crop price from June 1st of the prior year to December 1st of expiration. So this would be 22's crop, the crop we're using up to December 1st from June 1st of 21. And here is the 23 December contract from June 1st of 22 to today. And it's interesting how compare this to 2012 and 2013. So first, comparing it to 2012, and we can see we really just kind of tracked the same pattern coming into this. In 12, we had fast planting also. Going to probably hang out in that mid 5, lower 5 level till we see, really, I'm guessing we're right out here about at pollination time and see where our crop has developed. And then from there in 12, it took off. We saw the drought nationwide, and especially in Iowa, Illinois, and some large producing states, probably Nebraska, also very warm and dry that year. Now contrast that with 2013, the year following the drought, and when, as you can see, it really kind of followed that same pattern. But here in 13, we had a great growing year across the nation, and prices continued to fall. So a lot will depend on, for corn, on our growing conditions in the U.S. So we got about a month and a half to. It's probably going to hang around in that $5 to $5.50 range, and then we'll see where it ends up or how it looks for pollination and estimates on yield towards the middle to end of June, beginning of July. Switching to soybeans. What do I want to say on soybeans? Not as much. Well, exports falling off, and also falling off for next year. Really, the futures right now are probably pricing in about an ending stocks of 350. So in that and we're anticipated at 334 to 350 for our ending stocks. You know, early on in 22, there was a lot of talk of the crush and the need for the aviation fuel and that type of thing. A lot of those plants, if they continue to be built, won't come on to production until 24's crop. So I think some of that excitement has slowed down, and although in the US crush it has held up well, as we see graphically, we'll just look at the line items through the graphs here. And again, it's that export story that's falling off. Brazil having a great crop. I think another thing on grains, especially corn and wheat, is the corridor for Ukraine and Russia grain to be exported continues to stay open despite some sanctions and things that were put on and threats. Russian grain continues to reach the market. And harvested tends to be about the same as what's planted for soybeans. Anticipating the yield, I think it was right at 51, 52 bushels per acre. We've been right in around that 49 the last few years for a yield on a nationwide basis for soybeans. Again, good planting progress this year, so a lot will just depend on growing conditions. And we see that ending stocks taking quite a jump from that 200 level up to around 350 for the new crop that's we're putting in the ground currently. Again, this was put together by Dr. Dearson, and our ending stocks to use ends up around 7 or 8. So we're not down to that level yet for price. We'll hope that $11, $12 mark will hold on our futures, and we'll take. I did a comparison also on new crop soybeans. Here again, split him into thirds, taking the high and a low down in here, and then just dividing it by 3 and drawing the lines across. So did just some comparison years, again, June 1st to November 1st of the current year. So we're talking June of 22. And then this is the new crop 23, November 23 of soybeans. So we hope for it to kind of take stay above that $12 mark and kind of hang around in there. We can, but boy, look at where it has been recently. Still probably pretty decent price that you can get going forward, you know, and a lot's really going to depend on our growing conditions as we go through, and as the demand for exports or Brazil's crop, how they finally end up in what's out there for exporting. The other interesting thing is hay, and this has implications for expansion of the beef herd. We are very low for hay stocks in the US. And here's showing production, but this tan line is our December 1st stocks, and that's right at 72, closed out this last year in December 1st. And that probably needs to be around 80 before we see much expansion in a cow herd. Just people are not comfortable doing that without more reserve in hay. Now, if we go back to this time frame in 12 and 13, it did rebound fairly quickly. on from 12 into 13. And then we did start to see expansion. Took a couple of years yet for pastures to recover and stuff. But 14, 15 started to see more expansion in the beef cow herd. And our May 1 stocks low too. And a lot of us, show a map here coming up, but a lot of it's south and to the west of us where they've been very dry, continuous and reduced stocks. As you can see by the graph, the change in Nebraska, Colorado, Oklahoma, Texas, and then all throughout the South and Southeast. So I would anticipate, hay to stay reasonably tight and prices probably elevated. They will have to adjust a little bit as corn and other feedstuffs go down, but still fairly tight across south of us for sure. That's what I have.